in 2020, they acted immediately. The Congress or whoever was in charge of locking down the planet said, look, we're going to do this. And the Fed says, okay, we'll print $4 trillion like in the next day, or 2, 3, 4 days, whatever it was. So it's going to be very quick, but it's going to be very extreme. In terms of will it be felt in the stock market, I don't think for beyond a day or two in terms of nominal values. But once the printing starts this time, I think we're going to see gold and silver, especially silver, really start to move like in ways that are going to be scary even for stackers.
The Federal Reserve's fiscal year 2025 budget allocates $42.5 million for currency production, accounting for 67% of the total $64 million requirement. The annual print order increases from 5.56 billion notes in 2024 to 6.8 billion for 2025, a 22% surge, indicating monetary system pressures. Rafi Farber, author of The Endgame Investor, observes that financial crises are intensifying as the fiat system evolves. Central banks respond with increasing urgency, as evidenced by expanding print orders. Historical data show consistent erosion of purchasing power despite inflation control mandates. A $1,970 requires over $7 today, with the US dollar losing more than 90% of its value since abandoning the gold standard. Currency production acceleration creates cycles that require additional printing to address the consequences of previous expansion. Economic conditions and global factors create complex dynamics as physical note production increases alongside the expansion of digital monetary systems. Traditional models struggle predicting outcomes when authorities employ extensive measures. The substantial rise in currency production illustrates the current scale of intervention. Farber's analysis reveals that the monetary backdrop has remained essentially unchanged since 2020, with financial markets continuing to operate on remnants of massive stimulus programs that are now nearly exhausted. As this liquidity diminishes, he anticipates that the recent consolidation period for gold is coming to an end. His projections suggest that a breakthrough above $3,500 could trigger a sharp rally lasting 1 to 2 months, potentially driving prices toward $4,000 or higher. This outlook aligns with forecasts from major Wall Street institutions. Goldman Sachs, JP Morgan, and other prominent analysts project that gold will reach $4,000 by mid-2026, representing significant growth given that gold crossed $3,000 in March and first closed above $2,000 in April 2023. While acknowledging potential temporary market declines, Farber remains optimistic about precious metals, particularly silver, expecting substantial gains during the next monetary expansion cycle. This video examines how the fiat system is steadily losing value and why another round of money printing could trigger a sharp rise in the prices of gold and silver. Like and subscribe for weekly, data-driven insights that support our ongoing analysis.
Since 2024, I think, the beginning of 2024, we've had a few consolidations in gold. There are many different ways to count a consolidation. You can debate where you want to start counting, where you want to stop counting. But if we just take just a general idea of what a consolidation is, the price doesn't go beyond a previous high, then the average length of a consolidation since 2024 has been about 4 months. There's been one that was 3 months. And usually the rallies are between 1 and 2 months. So the rallies are shorter in time span than the consolidations. That's how it's been. Doesn't mean that's how it always will be, or that's how it necessarily will be this time. But nothing fundamental really has changed since the beginning of 2024. We're still operating on the leftover printing from 2020. We're almost out now, finally. But we're still operating on that. So it's the same basic monetary structure. So, based on that, it just seems like there's a good chance here that the consolidation in gold is pretty much over. And once we pass 3,500, we should start seeing the next rally, which shouldn't take too long in time span. It should be about 1 or 2 months until we get to a new plateau. Could be 4,000, could be higher than that. It's hard to tell exactly where it'll stop. But in the meantime, we also have to look out for the end of the last tranche of 2020-2021 printing, money printed fuel. And because we have now still about $100 billion left in reverse repos, which is the backup money supply that comes in every so often, that's still going to run out. And when it does, the Fed is going to have to print again because all of the extra reserves are still being used in the plumbing of the system, and they can't be double booked. They can only go in one direction. And all of the hedge funds and everything like that uses that money, they need that to keep coming, or they have to close their trades, and that could cause a systemic toppling. So before that runs out, we should see gold start to rally, and I'm not discounting that gold and silver will get hit, perhaps severely, though less severely than most other things, in the event of some kind of a clog in the plumbing. But that's only going to be like, a few days until the Fed responds, and then we should see a slingshot. So I'm not counting that as part of the trendy consolidation versus rally. That's something else. Like, for example, if you look at 2020, like February, March, April 2020 in gold, it was a humongous dip, and it was one of the worst dips in history for gold stocks. But if you look on a chart that's 5 years or longer, you don't even see it. It's not even there because it was so short. This one's going to be even shorter. It's going to be very scary, but it's going to be shorter. In terms of percentage, I think gold was like 25% from the top. Maybe in February 2020 or early March 2020 to wherever it stopped at 1450. I think it was like maybe 1800 down to 1450. What percentage is that? It's something like 25% from, and I don't think I'm wildly off there. I'm just not doing the math in my head. So, we could see something like that. What's 25% of, let's say, 3,600, about $700 down. So could I see a crash in gold to like maybe 2,800, 2,900 and real panic on a repo crunch? Yeah, it's possible. But most of my positions were established way before 2,800. So, unlike 2020, which really got me, my heart pumping in a bad way and, sweating, I held on. But this one, it would be like, a little bit, like a mild roller coaster, like something I could handle. And I'm sure most of your followers could handle it too if they got in before 2,800. So it'll be difficult, but it won't be a 25% dip from here wouldn't affect most of the stackers as, a 25% did from 1,800 to 1,450. So it could be a similar breadth or a similar move percentage wise, but I don't think the stackers are going to be fooled like they were last time. As you go down the fiat process, crashes get closer and tend to get more intense. But the intensity also, on the one side, yes, they do get more intense. On the other side, the Fed becomes more aware that it's going to have to act sooner and sooner following any kind of sign of stress, which is what we saw in 2019 and in 2020. And I think we're going to see it again. So we're going to see some kind of intense move, but we're also going to see the Fed act very quickly, where in 2008, it took them, maybe, a few months. It depends where you count where the stress started. You could count it years, starting with the top in the real estate market in 2006. You could start it the excess reserves or whatever they were doing in the banking system in 2007, where they allowed the Fed to pay interest on excess reserves. Most people don't know that entire process, that entire set of rules was only instituted once the banks told Congress, look, we need the Fed to be able to pay interest on excess reserves to keep all these reserves out of the monetary system because otherwise everything's going to explode. That actually happened before the financial crisis even happened. So you count it in many different ways, but however you count it, it took the Fed some appreciable amount of time to really get moving, right? In 2019, it was much less. It was like they saw repo going up and up for maybe a week or two before they moved. And then they only moved when it really spiked. And in 2020, they acted immediately. The Congress or whoever was in charge of locking down the planet said, look, we're going to do this. And the Fed says, okay, we'll print $4 trillion like in the next day, or 2, 3, 4 days, whatever it was. So it's going to be very quick, but it's going to be very extreme. In terms of will it be felt in the stock market, I don't think for beyond a day or two in terms of nominal values, but once the printing starts this time, I think we're going to see gold and silver, especially silver, really start to move like in ways that are going to be scary even for stackers. Because if you put yourself in our situation, in order for silver to, let's say, move like 20, 30% a day, when that happens, we're going to see some really scary stuff happen in the equity markets, happen in the bond markets. Prices, oil is going to start heading up. Commodities are going to start heading up, not as fast as gold and silver, but they're going to start heading up very scary. And we're going to feel like, happy, but, worried at the same time. That's when we know that we're really close. When our happiness is tempered by our own fear, even if we're in a good situation financially, which is, once you start feeling that, you'll know we're almost there. there. And I think that's going to start to be felt once the next printing round begins, whenever the last bits of monetary stimulus from 2020 finally run out. Should be in a few weeks now.
The financial system faces escalating risks as margin debt reaches unprecedented levels, with Rafi Farber highlighting that total margin debt has surpassed the psychologically significant $1 trillion threshold. While this milestone alone may not represent structural uniqueness, Farber emphasizes that the acceleration rate of margin debt growth presents far more concerning implications for market stability. Recent data confirms the severity of this trend, with FINRA's latest figures through June revealing record-high margin debt at $1.007 trillion. This represents the second consecutive monthly increase, featuring a substantial 9.5% jump from May, the most significant single-month increase recorded since November 2020. The debt level demonstrates remarkable growth momentum, rising 24.5% compared to the previous year. Farber points to particularly alarming monthly growth rates, noting recent periods where margin debt expanded to over 15% per month, marking some of the sharpest increases in financial history. These acceleration patterns suggest investors are taking on leverage at unprecedented speeds, potentially indicating either extreme market confidence or dangerous speculative behavior. When adjusted for inflation, the debt expansion remains substantial, with month-over-month growth reaching 9.1% and achieving its highest level since December 2021. The year-over-year inflation-adjusted increase of 21.3% demonstrates that margin debt growth significantly outpaces general price increases, indicating genuine expansion in leveraged positions rather than merely nominal currency effects. Let's get back to the interview.
And I queried some AI on this just to make sure I'm right. I don't use them for my primary research, but I check my conclusions with AI to see if there's something wrong with them. So this checked out, at least. So if you imagine what's happening in a margin trade, when let's say an institutional trader wants to increase his position for his clients, so he borrows on margin from the broker. The broker's got to get the dollars from somewhere. The broker gets it from the bank. The bank gets it from the repo market, at least, about half the time. So what happens is ultimately you have this loan that's secured by equities by the client to the broker, right? The broker pledges his securities, which he still owns, but the broker maintains his right to sell those securities by force if the margin loan can't be paid in time, if it gets called in. So that puts the client of the broker in danger of having his stocks force sold. And the broker itself has to pledge those securities to the bank, right? The same securities that the client pledged him, ultimately they're pledged to the bank. So the bank has to sell, it's really not up to the broker. The broker is just a middleman. The bank has to sell the securities so it doesn't get its dollars back. But where does the bank get its dollars? It gets its dollars from the repo market, for which the bank that's giving dollars ultimately lends the repo market every night treasury securities. So these margin positions are ultimately dependent on the treasury securities that are pawned off to the repo market to another bank to secure the dollars that some other bank has in reserve. So since people are always asking for more and more margin, as we see, I think Andy Schefman talked about this you interviewed him recently, and he was talking about how margin loans have exceeded $1 trillion. There's no significance of $1 trillion other than that we're base 10 humans because we have 10 fingers and 10 toes. So 1 trillion is a psychological number for us. But what's more significant is that the rate of increase in margin, the amount of margin debt outstanding that's ultimately secured by treasury securities, right, that the rate of that has been going up and up. The acceleration has been going higher and higher. And we've had 2 months of, I think, above 15% monthly acceleration, which we only had, I think, once in 2000 or 2 months consecutive 15% or higher, something like that. I know it's in the double digits, and it's among the highest months of acceleration in margin debt ever. So what happens is if the dollars run out in the repo market, right, and then the amount of interest that you have to pay, because it's supply and demand. If there's more demand for the dollars than there's dollars available, the interest on those dollars has to rise. And that means that ultimately the client that's taking the margin right? He has to pay higher interest rates. If he can't pay them, right, in order to pay them, you have to, because he has no cash in his account, otherwise he would be trading on margin. He's already fully positioned, so he can't pay those suddenly spiking interest rates. And then they have the broker gets called in by the bank, like, you have to pay me that interest because we're having a repo clog here, and the interest is going up on those daily, nightly repo loans. So you have to sell those positions and pay that interest. And then the bank said, but if everyone's doing that, everyone has to sell the positions, the value of the stocks that they bought on this margin loan are going to go down together because everyone has to sell it, pay the interest rates. Right? And then if the value goes down enough, then if it goes down enough, then they can't pay back the margin loan itself, the principal. If the value of the stock's being pawned off for the margin rate, for the margin loan in the first place, can't be pawned off, and then the bank itself gets in trouble because the bank is the one that pawned off the treasuries in order to get the cash in the first place to give to the broker to give to the client. So if the bank's treasuries get forced sold, so the bank has to sell those securities plus some of its securities that they secured with the other bank to get the dollars, then you have a whole bunch of treasuries being forced sold at the market in order to pay back these margin loans. So what you have is eventually, if it's allowed to go on long enough, let's say a few days or a week or two, which I don't think it's going to last that long because the Fed's not going to allow it, then you have the situation of stock positions being forced sold to pay back repo margin loans. And if the value is not enough because everyone's selling, then a lot of treasuries get sold in order to cover the repo loans where the stock values can't plug in the hole. So you have rising interest rates, short-term interest rates on the repo market, plus rising long-term interest rates if treasuries are being repossessed in order to pay back these repo loans, and everything's falling at the same time, which would include gold and silver and everything except the US dollar itself very temporarily until the Fed steps in, which is what it's going to have to do. Everything the Fed does is by definition a bailout because they create claims on gold that doesn't exist and give it to people so that they can spend. Whatever the Fed does is a bailout. It just comes in bigger or smaller chunks. So basically a bank can do whatever it wants, and it might experience some minor consequence somewhere. You have a headline, Wells Fargo paid $2 billion in fines for spoofing or whatever it is. And then, the article goes into what spoofing is and why it's immoral. But then again, the entire banking system is being bailed out every day by the Fed providing whatever it is on the back end. It's just that we see it more in chunks when it happens in a bigger way, like we saw in 2008, like we saw in 2019, like we saw in 2020. Like they could shut down the entire planet without consequence. Not without consequence. There will be consequences, but you can delay them with inflation, or you can spread them out over a longer period of time with inflation, so they're less noticeable. Right? If there was no Fed and there were lockdowns, people would starve within days. And that didn't happen because of the money that was printed that could just flow through the system and keep it sort of kind of working so that nobody starved to death. But yeah, so if we're going to take the example of executive function with children, the bankers today, they don't even know that what they're doing is, most of them don't know that what they're doing is wrong morally. They don't know what money even is anymore. They're proud of how they are handling the current pyramidal structure, which if you listen to the details of it and listen to them explain, some of them are very smart people, and most of them they're not nefarious people individually. They're not trying to hurt anybody. They're just doing what they see as the system and they're trying to keep it in balance. So that's what they're supposed to do, but they don't know that it's wrong. Just like kids don't have an executive function because they were never taught what following directions is. Bankers don't know what they're doing because they've never been taught what money is. It's the same thing. It's just one is the entire society, the entire economic structure, and the other is one child who was never taught by his parents to listen to what they say. A lot of people on the margins are going to lose their jobs. I'm in the US now, and I'm seeing really concentrated trends in certain industries that are kind of scary. I mean, if you think about them, like every billboard that I see is, some kind of, not every single one, but like, so let's say, 50-60% of all billboards as I drive on the highways, they're about, there's this big amount of money, let's say $500,000, and some injury attorney, you're talking about how he can sue for you. I hear these ads on the radio nonstop about the same thing. everything's concentrated now. All the money's concentrated in insurance claims and accidents and injury claims and whatever. All this is where all the big inflation is going, or part of it. So when you have a society that's so concentrated in these very specific areas that are not very productive, all of that money goes away, and you have all these people in these very inflated industries that are suddenly unemployed, and they have nowhere to go because there's no demand for their services anymore. The people that are in the very concentrated inflation influenced areas like litigation, that's one of the reasons we have such a litigious society.
As collateral values plunge and margin calls accelerate, investors would be forced to liquidate assets across the board, triggering widespread declines in stocks, bonds, and even gold and silver. Treasury markets, once the foundation of financial safety, would become a source of volatility as banks unload reserves to stay afloat, pushing long-term yields higher. At the same time, dollar scarcity in the repo market would drive short-term rates upward, deepening the squeeze of liquidity. Even traditional safe havens would experience temporary sell-offs, not due to fundamentals, but out of sheer necessity. The US dollar would surge briefly, not from renewed confidence, but from a desperate need to meet obligations. Without swift and coordinated central bank action, this self-reinforcing loop risks spiraling into a full-blown systemic crisis. Stay tuned for more real, data-driven insights into the evolving financial landscape. If you value grounded analysis, please hit the like button and subscribe so you don't miss our weekly updates. Thank you for your support and enjoy the video.